Hello, I'm Hickey from interest.co.nz and welcome to a special report on the Reserve Bank's December quarter monetary policy statement and its announcement on the official cash rate. And I'm here at the Reserve Bank in Wellington, where we've just heard Dr. Alan Bollard talk about why he's left the official cash rate on hold at 2.5% and why he seems to have brought forward the timing slightly for a rate hike next year. Up until now, he's been saying he'd look to increase the official cash rate from its record low 2.5% towards the second half of next year. Now he's saying he'll do it in the middle of 2010. So he's given himself a little bit of wiggle room to do it a bit earlier. And that's because the global economy is looking better and because the New Zealand economy is looking better. And there is actually some inflation pressure starting to build, particularly in what they call the non-tradable sector. Now, this is inflation that's generated domestically, nothing to do with international prices. And the Reserve Bank has lifted its forecast for non-tradable inflation from 2% to 3%, which is right at the top of the target band. Although, to be fair to the Reserve Bank, their target band is 1 to 3% for overall consumer price inflation, which includes some of that tradable inflation, the stuff that's coming in from overseas. And with the New Zealand dollar relatively high, and with interest rates at the long term, fixed mortgage rates, also being higher, the Reserve Bank thinks that there's no need right now to put up the official cash rate. Now that may change next year, and we may well see Alan Bollard give himself a bit more wiggle room to bring forward that official cash rate to perhaps sometimes earlier in 2010. Because we're seeing the Reserve Bank of Australia put up its official cash rate, and central banks and governments around the world are starting to withdraw some of this pretty heavy fiscal and monetary stimulus. Now, some comments came out of the press conference that were interesting. Alan Bollard pointed out that house prices are likely to rise 12% in the March quarter from the same quarter a year ago. That's quite hefty house price inflation. And in the past, that has been translated into debt-fueled consumption growth, which is something the Reserve Bank obviously doesn't want. But it's saying it's different this time because people seem keener to repay their debt and to keep their interest payments where they were before, even though they could reduce them slightly. And that means that New Zealanders have been a little chastened by what they've seen in the financial crisis and are starting to save a bit more and repay debt. There's also some anecdotal evidence that some people are trading down in their houses, selling their expensive house, going for a slightly cheaper one, and reducing their debt. The Reserve Bank says that credit growth from the banks remains relatively subdued, and that's why it doesn't see a boom happening in house prices that is translating through into the wider economy. And it's actually forecasting house price growth to drop from that 12% in the March quarter down to 2% in 2011. However, it is a slightly risky approach, I think, to keep the official cash rate at 2.5% when you've got house price inflation at 12% and non-tradable inflation up towards 3%. The Reserve Bank is effectively relying on higher long-term mortgage interest rates. Also, it's relying on the high New Zealand dollar to take some of the steam out of the economy, and it's also relying on the government to tighten its budget. There's always something else the Reserve Bank can point to say we don't need to increase the official cash rate. I actually think they should increase the official cash rate probably early next year, because this housing market, even though it doesn't seem to be translating into debt-fueled consumption growth, is still growing quite strongly. I'm Hickey. That was a special report from the Reserve Bank's monetary policy statement for December from here at the Reserve Bank in Wellington.